Greetings, I'm Rick Ward. I'm an investor, an entrepreneur, and a wealth architect with Working Class Wealth Creations. I've put together this little mini series. It's made up of excerpts from my upcoming book, My Road to Wealth. Each little episode will give some handy hints for you as a beginner, as an investor, to help you along with your journey as a first-generation wealth creator. So let's have a look at some of these beginner tips for investors right now. Looking back at my journal and the morals of the story. Okay, so starting with the first property, my Kubla property, I learned to use your social networks. You have people around you that either are in the real estate business or know people in the real estate business, and I can introduce you to this. And so you can get a bit of expertise and start to understand what buying real estate's all about, and find these networks that can be really quite helpful. Just trying to go it on your own and make it up as you go is a very risky proposition. You can be a bit strategic, and you don't always have to do the norm of having the full 20% deposit and going through a conventional bank, things like to make a real estate deal work. In some situations that you don't have those savings, you're gonna find other creative ways of doing it. There's a lot of information on the internet, and I'll cover some of it as we go through. And on my YouTube channel, Working Class Wealth Creations, I'll give you some examples of different things that I've done that's a bit out of the box. And so don't be afraid to be a bit creative. With your first deals, it's always easier if you can be more conventional. But as you go along, you will have to be more creative, and you develop a investor mindset that you'll see deals and see the world in quite different ways. And try to keep your emotions in check. Buying property is very emotional, whether it's your own residence that you can live in yourself, or it's an investment property. Investment properties will be more around your emotions of greed and scarcity and things like that, because it's your money, and that's a very scary proposition because it's big numbers. You can buy a couple $100 worth of stock, but you can't buy a couple $100 worth of house. So those emotions kick in. And then when you're buying your own property, there's a lot of factors in there. You still have the same ones with the finance, whether you can be able to afford it, how much upkeep is going to be required, the neighborhood you live in. You may have your own stigmas or ideas around that, the quality of the schools, infrastructure. There's a lot of emotion involved with that. And that can be fine when you're buying your own property. But as an investment property, you really got to start adapting an investor mindset and taking as much emotion as you can out of it so you can think clearly and make better decisions. Although when my first property, putting in a swimming pool and pergola and things like that, people say you never get your money back out. You're overcapitalizing in the property. But at the time, I had no intention of moving. That was going to be my house for life. I was going to raise the kids in it, and the kids love the swimming pool, and I was just going to make it as nice as I could. And that's absolutely fine. I didn't worry about people telling me I'm overcapitalizing, but it's something to keep in the back of your mind. It's unlikely that in today's generations and things like that they're going to stay in the same house forever. It's quite a mobile workforce, quite a mobile society. People today like to travel more. There's a lot of other things that it's likely that you'll change jobs and change homes several times through your life. And that's the case. You want to make sure that you don't dig yourself too far in a hole, because you need some of that equity when you sell it. That's one of the huge advantages of buying over renting. Renting, that money's just gone, where if you're buying the property, chances are you're going to build up some equity while you're there, and you'll be able to get some money out to help you to your next place. When you're looking at properties, wear your investor hat. Learn about the nuts and bolts about it and not any local prejudice. You can miss out on some great deals just because of your local prejudice if it's an area that you invest in. That's why I don't have any investment properties close to my home, so I don't get caught up in that, because I missed out on some really good deals that were local to me. They were in up-and-coming neighborhoods, and there was government renewal projects kind of happening in there. And with the knowledge I have now, I know those have been fantastic investments. They went through the roof. But I didn't want to buy that $60,000 house because I was afraid what sort of tenants I would get. It's not a good neighborhood. It's going to be hassles. It really hasn't did much over the past 10 years. There are better areas to invest in. But that $60,000 house became a $250,000 house in a couple of years when the project was complete. So again, I missed out on some fantastic deals where I could have gained a lot of wealth in a very short amount of time, but it's my own prejudice and stigmas that held me back. Sticks to facts and figures and numbers. Infrastructure, what's happening, locality towards trains and freeways and the beach and shopping centers, things like that. And just take that stigmas and emotion out of it and just look at facts and figures and what's going to happen to make the best decision. And do as much research as you can. Research is at your fingertips right now. When I started out, you had to drive an hour to Perth to go to the Value General and then pay $15 to find out what somebody had paid for a house. Now all that stuff's for free and it's right on the internet, and it's just, you can scan through, because the more you have a better idea of what the seller has bought the house for. Now they likely have refinanced and that debt may be more, maybe less, but you got a ballpark figure of what they paid for it. And so you want to make your offer as reasonable as possible. If they paid $250,000 for that house and you offering $100,000, it's not going to get it. Find out what the market research is. What is properties in that area and that street selling for today? Similar properties, do your comparables, and make your offer a fair offer. Don't try to steal a property for somebody. You can offend it, and again, you'd miss out because they'll be offended, particularly owner-occupiers. They'll be offended and they won't want to deal with you. It doesn't matter what you're going to offer them now because they don't like you. Always be fair. I typically, as a rule of thumb, if I'm not really sure what their motivation is or what they paid for or something like that, or what they might owe on it, I look at their asking price and I usually offer somewhere between 10 to 15% less, unless it's a hot market. If it's a hot market, I will offer full. And if it's a very, very hot market, I won't be in it. When it's in a seller's market, don't try to lowball people and steal it up from under them, because they know they're in the driver's seat. And if you don't give them what they want, somebody else will. You offer them full market price. It's very hard for them to turn that down. You don't want to get into a bidding war either. If you offer under, then somebody else, there'll be multiple offers. The negotiations go back and forth, and next thing you know, you're paying more than they originally had asked for the property. But that's also a sign of the market might be getting too hot to be in it. And if you can, don't be afraid to ask the agent, what's your motivation for selling? How long's it been on the market? What do they plan on doing? Are they going to rebuy? Are they moving away? And that'll give you some insight too. If they've taken a job interstate or overseas and they're kind of under pressure to sell, they're far more likely to be a bit more flexible in their asking price. If you can structure the offer in a short settlement time, cash deals, anything that you can do to make it easier for them to accept your offer, better chance you'll have success. And part of that research too is talk to your local councils, see what's happening in that area, what infrastructure is planned. This can work for you and against you. When I bought my own property here, I looked at the council and I knew that there was a freeway that was going to be running just alongside my estate, which will open everything up, and there'll be an exit just a couple hundred yards away from my house. I'll be able to get on and off the freeway. I know that would add a lot of value for access. It opened up this region, which was all farmland before, for commuters, so that was going to be a positive thing. What wasn't on the plan at the time for the short term, but it wasn't a long term, was a train system is going through. And that made phenomenal changes to the value of our property. Even though the train line ended up getting diverted several kilometers away, it still opened this region up with both the freeway with the cars and the train system. And our block of land here, when we purchased it at $135,000, when the freeway went through, these blocks went for about $200,000. And then when the train was running through, these blocks shot up to $700,000. So it pays to do your research. Now I've been burnt the other way as well. It really wasn't to do with my research, but another property I bought that was up in Port Hedland, which I still own today. When I did the research on it, it was doing an urban renewal, and so I thought that's fantastic. This area's going to come up. It used to be the worst neighborhood in South Hedland, and I knew from my other investing experience that this was really going to go well when they redeveloped the area. So I said, there's no problem there. I was paying top dollar because of the heat of the market, and I probably shouldn't have bought it, and that's, again, if you want more information on that, you can look at 3 Corbett on my Working Class Wealth Creations Road to Wealth. But what I got stuck at there is somebody would have bought it otherwise. Would have found out that 2 doors down, they were going to be building a youth refuge, basically for street kids. At the time I bought, that wasn't there, but very shortly after, and it might be. Some of these things, it could be a prison, it could be a youth hostel. There's a lot of sort of things that will attract antisocial behavior, skate parks, they sell, real estates will sell them as a wonderful thing for kids, but being next to a skate park is good. You want to be close to a school, but not across the street from a school. There's a few things around that. So you do a bit of research, and if they find out that they're building a prison on that big vacant block just down the street, then I would stay away from it. That's really going to hurt your resale value later on. And anything to do with drug rehabs, youth hostels, things like that, I would shy away from those sort of things as well. When you go to sell, do your research again, do your comparables. Just like buying a property, when you go to sell one, you look at what all comparable properties are selling. What's a 4x2 on my street selling for? Recent sales, what's the market like now? And put your price there. You know, what is a real expectation? You'll sell much quicker, less hassles. People always want to put their price up and test the market. They say, oh, we'll put it, 100 grand, 50 grand higher than what's reasonable, what's going to be selling there. And it turns out that that the property just sits there. And when people do their research and see this thing's been on the market for 6 months, well, obviously there's some problem with it, so they won't even look. And even if you were lucky enough to find somebody that was just emotionally attached to it, maybe they grew up in that house or whatever, and they're willing to pay the extra 50 grand, chances are when the bank does their valuation and doesn't value up, they're not going to get finance for it. So you've wasted everybody's time. So when you go to set your price, set it the same way you'd buy a property. If you want to any sort of test the market, you go 10 to 15% higher than what it actually should sell for. Because at that 10% variance, if it's a hot market, the valuers will probably go with that. If it's a slowing crashing market, there's not a hope. They're not going to go over what the statistics say they're going to get. And then you can always negotiate down, and then the buyers feel that they're getting a good deal. So leave 10 grand. I wouldn't go any more than 10 grand regardless of the prices. You want to keep it as close as possible. A bit of negotiation there, and stay firm. Another little trick on negotiations, you pretty much find out you've set your number there. They're going to give you a number, and the number between those two often that's where your sale price is. And so look at that. If that in between is still within your range, then accept that and lock them in, and away you go. If it's a way lowball offer, then take $1,000 off. And you get them, where your sale price is, and you want to get them in. You want to get that price in there where it's going to be acceptable to both of you, with the least amount of negotiations. As it goes on, it's very draining and frustrating for everybody. There's another advanced strategy that I haven't talked about yet that I'll have later on. It's when you are selling, if you're going to continue, getting finance for the properties is always the hardest. That's where your biggest hassles is going to be, is trying to get finance. One of the ways you can alleviate that is when you got equity and you got a bit of a portfolio. Say you have a loan for $300,000 and you sold that house, but you have enough equity in your portfolio that you can keep that loan. You can get the bank to discharge the title in the sale, and you keep the loan and pay that loan down to $1,000. And now you virtually have a pre-approved loan. It's already there. So the next property, you can use that $300,000 for several deposits on other properties, or you can pay cash for it. And that's really powerful when you go to negotiate for houses. If you can pay cash, if you have the facilities, whether it's a line of credit, offset accounts, or like this strategy of having a whole loan that is no property attached to it, but you can just reach in there and tell the owners, I can give you cash at the end of the week for this, and we can do settlements in 2 weeks. Have a good relationship with your settlement agent. How fast can you do this? That's very powerful, particularly people in binds that got to move, or it's divorced or emotional, they just want to be done. The sooner you can get cash in their hands, the more powerful your offer can be, and they're more willing to accept a far lower offer if they can get that cash quickly. And again, selling the family home can be quite an emotional thing, and you got to make sure that you're both on track with that. That first of all, you both do want to sell, and that you've worked out a price that you'll accept. The relationship that we had, my wife is still quite attached to her house, and she thought it was worth a certain amount of money. And statistics and all the data had showed that, well, it actually wasn't worth that much. But she held on to that basically for two reasons. One, she wanted to make more money on it. And secondly, she probably wasn't fully emotionally ready to sell that. And so we hung on to it for a fair while. And eventually, when she was ready, she accepted to put what the price should be, and we sold it straight away. Had I tried to force her or guilt her into selling it, it probably would have damaged the relationship and it would have made it everything a whole lot worse. Make sure that you talk through these things and you're both on board with selling the property first and the price you're going to sell it for. Now that's to do with family homes. Investment homes can be different because maybe only one of you are actually going to be an active participant in that. I find it always a good sounding board. I explain the deal to my wife that this is what they're asking for, this is what I'm going to give them, this is what I think it's worth, this is the rental statistics, why this works. And that had two effects. One, it relieved some anxiety in her that I knew what I was doing and we were going to make a good deal. And secondly, it helped me really think through the project, make sure I have thought of everything. And she would come up with questions sometimes that I wasn't really prepared for. Oh, shit, I'll go look at that. And come back and give the information. Once she was fully sound with the idea, then I had really worked it through, that I knew that we were making the right choice on this. Now, is it always the right choice? I'll talk about it. Other deals, these X factors that fly up. At the time, it was the right decision based on all the information I had at the time and the experience that I had at the time. A really safety factor in buying property is buying in a flat market, in a buyer's market, in a depressed market. And watch that market and study the trends over time, and you'll see that it'll bottom and then start coming back up again. You want to catch it up if it was a clock face and the 12 was a very peak and then it crashed over, and as it comes down around, you just watch, and then everybody wants to buy at the 6 o'clock, but you don't know it's 6 o'clock until it hits up to about the 8. So let it bounce, because you get a lot of what they call dead cat bounces and things like that goes a bit sideways at the bottom and you're not quite sure. But when you got a strong uptake and you're about the 8 o'clock mark, then you know that you're heading in the right direction. If you buy there, even if you pay too much or you buy a lemon for some reason or some issues, you've got a lot of uptake there. It's very quite safe. The market on this side just steadily climbs. It gives you some time to research things more. And chances are it's much safer. If you have to get out again and you've bought well, then it's quite easy. If you buy on this side of the clock, as properties are falling, you think, oh, there's some really good deals, but you've got to keep that falling till it's the bottom. So you might be in quite negative equity before you start getting some upswing. To make a whole cycle in most places is 7 to 10 years. But this was 12 o'clock to 6 o'clock happens fairly quick. That happens within, a year, 2 years at the most. This side takes a lot longer, but then it gets faster and faster, and percentage-wise, it really starts picking up towards the end. So again, make sure that's the case. Make sure you're not buying, at that 10 to 12 o'clock where it's such a frenzy, when you got multiple offers on property, when you can't see when houses are being sold before you get a chance to look at them. We got a market that hot, just stay out of it. Everyone's worried about missing out, and it gets to be more and more of a frenzy. You just don't be in that. If you want to be investing, find another market or just sit it out until the next cycle. Or you can move across to other sort of paper assets and different things you can do there. But don't be fighting people competing for properties, because that's a sure sign that the market's too hot and somebody's going to get burnt, and I don't want that to be you. Well, I hope you found those tips helpful, and if you did, give me a thumbs up. This comes from an excerpt of my video book, My Road to Wealth, so look out for that. This is the kind of content that you're interested in how to create, manage, and retain your first-generation wealth. I encourage you to subscribe to this channel, and you can contact me directly on my email, workingclasswealthcreations@gmail.com, or you can follow me on my social media, Facebook, Instagram, Twitter, LinkedIn. So until next time, this is Rick Ward helping you on your road to financial independence.